Here's something most income investors never stop to check. That ETF paying you 8, 10, even 11%, it might be quietly costing you more than it pays. I'm not guessing. I'm going to show you the math. There's a fund called OVL. It pays roughly 10.5%. It holds the S&P 500, and since it launched in 2019, it has beaten the S&P 500 in total return. Not for 1 year, for every single measurement period. 1 year, 3 years, 5 years, since inception. That almost never happens with an income fund. By the end of this video, you'll understand exactly how it works. You'll see the real numbers, and you'll know whether it fits your situation or doesn't. And the part that made me look twice, this fund wins on roughly 80% of its option trades. I'll show you what that means in real dollars, and I'll be honest about what happens the other 20%. Quick note, I'm not a financial advisor or government employee. Everything here is for educational purposes only. For your specific situation, always check with a qualified professional. Let's get into it. What covered calls actually cost you? Before we talk about OVL, we need to talk about the income funds you probably already own. Covered call ETFs are everywhere right now. JEPI, XYLD, QYLD, JEPQ. The options income space exploded from under $10 billion in 2020 to over $300 billion in 2026. That's a 30x increase. So what do these funds actually do? They own stocks, then they sell call options above the current price. Someone pays them cash for the right to buy those stocks at a higher price later. That cash becomes your income. Sounds great, but here's the part most people miss. When the market rallies past that strike price, the fund gives up everything above it. Your upside gets capped. The income you earned, it came at the cost of the growth you missed. Let me show you what that looks like. Over the past year, the S&P 500 returned roughly 30%. JEPI, about 8.7% total return. That's a gap of more than 20 percentage points. XYLD's 3-year annualized total return sits around 11.5%. OVL's over 25% annualized for the same period. JEPI manages about $44.6 billion in assets. OVL holds around $287 million. The bigger fund has the bigger marketing budget. The smaller fund has the bigger returns. That's worth thinking about. Now here's the myth most people believe. Here's the myth. A 10% yield means the fund must be eating itself, slowly draining its own value to pay you. Here's the truth. OVL's share price has risen over time. Its net asset value was $56.79 as of June 22nd. The income comes from option premium, not from selling your shares. When NAV goes up while income goes out, the fund is not eating itself. It's earning it. So if selling calls above the market caps your gains, what happens when you sell options below the market instead? That's where everything changes. How OVL flips the script. OVL stands for Overlay Shares Large Cap Equity ETF. It's run by a firm called Liquid Strategies out of Atlanta. The fund does 3 things, just 3, and once you understand them, you'll see why the math works differently than a covered call fund. Piece number 1. OVL owns 100% of VOO. That's Vanguard's S&P 500 ETF, one of the most popular funds in the world. Your entire equity position stays intact. Nothing sold, nothing capped. Piece number 2. On top of that VOO position, OVL sells put options slightly below the current market price. A put option is like insurance. The buyer pays OVL a premium for protection in case the market drops. Most of the time, the market doesn't drop that far. OVL keeps the premium. That's where the income comes from. Piece number 3. Then OVL buys another put option even further below the market. This one is cheaper. It acts like a safety net, capping the worst-case loss on each trade. Think of it like selling home insurance on your neighborhood. Most months, nothing happens and you keep the premium, and the put you buy below is your reinsurance policy. It limits what you can lose if something does go wrong. Let me walk you through the numbers so it clicks. Say the S&P 500 is at 100. OVL sells a put at 98 and collects 50 cents. Then it buys a put at 96 for 20 cents. Net income, 30 cents. Now the market rallies to 110. What happens? Both puts expire worthless. OVL keeps the 30 cents, and the VOO position, it captured every single penny of that rally. No ceiling, no cap, full upside. That is the key difference. Covered call funds sell options above you. They put a ceiling on your gains. OVL sells options below you. It puts a floor under your risk. Income comes from below the market. Your upside stays wide open above it. And this isn't a fund that just launched. OVL has been running since September 2019. It has a 5-star Morningstar rating, and it switched to monthly distributions in early 2026, paying roughly 47 to 49 cents per share every month. So the concept makes sense, but how often do these trades actually work? That's where the 80% win rate comes in, and the answer is more interesting than the number. The 80% win rate, what it really means. Here's what most people don't know about the options market. There's a gap, a well-documented decades-old gap. It's called the volatility risk premium. From 1990 to 2018, the average implied volatility, that's what the options market expected, was 19.3%. The actual volatility of the S&P 500 during that same period was only 15.1%. That's a gap of 4.2 percentage points every year for almost 30 years. What does that mean in plain English? Options are priced for more fear than the market actually delivers. The people buying put options are overpaying for protection, and the people selling those puts, funds like OVL, collect that overpayment as income. That's not a trick. That's a structural feature of how markets price risk. When you sell a put spread that's slightly out of the money with a 2-week expiration, published backtests show these trades win between 70 and 93% of the time. The 80% figure you saw in the thumbnail sits right in the middle of that range. OVL runs these trades every 2 weeks. It keeps multiple positions open at once, staggered across different expiration dates. So it's not betting everything on one roll of the dice. It's harvesting small premiums over and over again. But here's the honest part, and I'm not going to sugarcoat it. Wins are frequent and small, losses are rare and large. That long put, the reinsurance policy, caps each individual trade's loss, and the fund's managers actively tighten their spreads when volatility spikes. They close winning trades early when the premium has mostly decayed. This is not a set-it-and-forget-it robot. The expense ratio of 0.79% pays for real humans making real-time decisions. Still, in a fast, severe crash, the put spreads can get hit hard before the ladder adjusts. That's the trade-off, and smart income investors deserve to hear it before they invest, not after. Before I show you the real dollar math, drop a comment right now. Are you currently holding a covered call ETF for income, or are you exploring something different? I read every single one. So the win rate checks out. The reason behind it is structural, not luck. But here's the question that really matters. What does all of this look like in an actual retirement portfolio? Real money, real risk, real decision. Let's meet Phil and Diane. They're 63, living in Ohio. They've saved $500,000. They need that money to start producing income within a few years. Option 1, they put all $500,000 into VOO. The S&P 500 pays about a 1.05% yield. That gives them roughly $5,250 a year, about $437 a month. That barely covers groceries. Option 2, they go with JEPI. At 8.45% yield, that's about $42,250 a year, around $3,520 a month. Much better. But over the past year, JEPI trailed the S&P 500 by more than 20 points in total return. They got the income but missed the growth. Option 3, OVL. At 10.5%, their $500,000 pays roughly $52,500 a year. That's $4,375 every month. And the total return since inception, OVL has beaten the S&P 500, 17.77% annualized versus 16.81%. Phil and Diane didn't just get more income, they kept their full upside too. And there's a tax advantage most people overlook. OVL uses index options that qualify for Section 1256 treatment. That means 60% of the gains are taxed at the lower long-term capital gains rate, no matter how long you held. On top of that, the fund uses what's called heartbeat trades to generate return of capital in the distributions. That means a portion of each payment is tax deferred. You don't owe anything on it until you sell. Compare that to covered call ETFs that mostly generate ordinary income, taxed at your full rate. For someone in the 24% bracket, that difference adds up fast. Now let me be straight about the risks, because this is not a free lunch. It's a different menu. In 2022, OVL fell 22.2%. The S&P 500 fell about 18%. In a slow, grinding bear market, the put spreads can lose repeatedly as each new ladder rolls into a falling market. That's OVL's weak spot. The 100% return of capital in the current distributions is constructive while NAV is rising. But if NAV were to fall and stay down while distributions continued, that return of capital turns destructive. The fund would be giving back your own money, not its earnings. And with only $287 million in assets, OVL is small compared to a giant like JEPI. That's not a flaw in the strategy, it's a reflection of awareness, but it's worth noting. Smart income investors don't chase magic. They understand the trade-off and decide if it fits their life. You're trading away some bear market protection for full upside participation and a 10.5% income stream. If that trade-off makes sense for your goals, OVL is one of the few funds actually built to deliver it. Covered calls sell your ceiling. Put spreads sell your floor. Same income, different sacrifice. If someone you know is investing for income and has never heard of this approach, share this video with them right now. It could change how they think about their portfolio. Now, I've got a question for you. What's the one thing about your current income ETF you'd change if you could? Tell me in the comments. If you're building income from your investments and want to stay ahead of ideas like this, subscribe to this channel. I cover everything that protects and grows your retirement income. And next time, I'm breaking down the 3 biggest risks hiding inside every high-yield ETF, including the ones nobody puts in the thumbnail. You won't want to miss that one.